Investing in buy-to-let properties can offer solid returns, but it's not without its challenges. Many new investors are attracted by the promise of consistent rental income and long-term capital appreciation. However, these idealized expectations can quickly be dashed when hidden costs and overlooked mistakes start to eat into profits. What initially seems like a lucrative opportunity can easily turn into a financial burden if you're not careful. In this video, we'll take a deeper dive into the 5 biggest profit margin killers in the buy-to-let market. Understanding these pitfalls and how to avoid them can help ensure that your property investments remain profitable and sustainable in the long run. The most significant profit margin killer by far is poor property selection. It's an all too common mistake for investors to focus too much on the initial price or the immediate rental income potential without considering the long-term viability of the property. A property that looks like a bargain today might become a financial headache down the line if it's in an area with low tenant demand, poor local amenities, or weak capital appreciation. Choosing a location that lacks demand can lead to vacant properties for extended periods, which in turn creates a cash flow problem. If your property is sitting empty while you continue to pay mortgage payments, your profitability will quickly diminish. Moreover, properties in areas with stagnant or declining capital growth will offer you little in terms of long-term asset value increase. For example, a property purchased for £100,000 in an area with no significant regeneration plans may not appreciate in value as much as a similar property in a town that is seeing a steady rise in demand or infrastructure improvements. This means that while you might be earning rental income, you won't see the same return on investment if you ever decide to sell. To avoid this, doing thorough research is essential. Consider factors such as local tenant demand, proximity to transport hubs, schools, shops, and other key amenities. Investing in a location with a strong rental market, increasing rents, and signs of regeneration can help mitigate the risks of vacancies and poor value growth. Online property portals like Rightmove and Zoopla can provide helpful data on average rent prices, trends in the local market, and other key indicators. Also, don't underestimate the value of local expertise. Working with experienced estate agents can help you get a much clearer picture of where to focus your efforts. Another key profit margin killer is underestimating the cost of refurbishments. Many investors plan to add value to a property by renovating it, only to find that the renovation costs spiral out of control. A simple kitchen update can quickly turn into a major overhaul, with unexpected costs creeping in due to issues like damp, structural problems, or outdated plumbing and electrical systems. What might seem like a £10,000 project can easily escalate to £15,000 or £20,000, significantly eating into your margins. Renovations often go over budget for several reasons. Labour costs can fluctuate, materials can increase in price, and unforeseen problems often arise once work begins. Additionally, delays due to the weather, contractor availability, or supply chain issues can extend the project timeline, potentially leaving the property vacant longer than planned. These factors can quickly erode your profitability. To avoid this, always get multiple quotes from reputable contractors and thoroughly vet them before committing. Don't simply go for the cheapest option. Ensure you choose contractors with a proven track record of quality work and reliability. It's also important to account for a contingency fund of around 10 to 20% to cover any unexpected expenses. Additionally, have a comprehensive inspection carried out before starting any work so that you can identify potential issues early. An experienced project manager can help ensure that the renovations stay on track and within budget, reducing the risk of costly overruns. Many investors make the mistake of overleveraging, borrowing more than they can comfortably afford in an attempt to maximize their returns. While borrowing might seem attractive, especially with low interest rates, excessive debt exposure can severely limit your financial flexibility and increase your risk of losses if the market turns. Overleveraging means you're more vulnerable to fluctuations in the market. For instance, if property values decline or rental income falls, the extra debt can become difficult to manage, leading to difficulties in covering mortgage payments. Additionally, if interest rates rise, your mortgage payments could increase, making the investment less profitable, or even leading to negative cash flow. In extreme cases, overleveraging can force you to sell the property at a loss, or in the worst case scenario, lose the property to repossession. To prevent this, be cautious with how much you borrow. Although lenders may offer high loan-to-value ratios, it's often wiser to aim for a more conservative approach with a loan-to-value of around 70%. This gives you more equity in the property, reduces your monthly mortgage payments, and provides a buffer against potential market fluctuations. The lower your loan to value, the more resilient you are to changes in the market, reducing the risk of having to sell the property under unfavourable conditions. Another common mistake made by new property investors is failing to account for the full range of ongoing costs associated with owning and managing a buy-to-let property. While the purchase price and mortgage payments are fairly straightforward, there are a variety of other costs that can quickly add up and eat into your profit margins. Maintenance, repairs, property management fees, insurance and taxes are just a few of the ongoing expenses you need to account for when calculating your potential returns. Even small issues like a leaking pipe or a worn out boiler can turn into costly repairs if not addressed promptly. In addition to maintenance costs, property management fees typically range from 8 to 15% of rental income, depending on the level of management you require. If you're not accounting for these expenses accurately, you might find that your rental income is barely covering your outgoings, leaving little room for profit. Furthermore, taxes such as stamp duty, capital gains taxes and income taxes on rental profits can significantly reduce your overall returns. To protect yourself, it's essential to create a detailed budget that includes all ongoing costs. Factor in regular maintenance and potential repair costs, as well as the costs of property management, insurance and taxes. It's also a good idea to build a cash buffer to cover unexpected expenses such as emergency repairs and void periods. Having a clear understanding of these costs before you invest can help you make a better decision about whether a property is truly profitable in the long term. Finally, one of the most common profit margin killers is failing to track your cash flow. While many property investors focus on long-term capital growth and the potential for property value increases, cash flow, the income you generate from rental payments, after all costs, should be your primary concern. Without regular cash flow monitoring, you risk running into situations where your property isn't generating enough income to cover your ongoing expenses. If you're not tracking your cash flow accurately, you might find yourself dipping into your personal savings to cover mortgage payments, repairs, or other unexpected costs. In the worst case scenario, this can undermine the profitability of your entire investment strategy. Moreover, failing to track your cash flow means you might miss opportunities to reinvest that income into new, more lucrative projects. To stay on top of your cash flow, it's essential to track all income and expenses carefully. Use accounting software or simple spreadsheets to monitor your cash flow on a regular basis. Ensure that your rent is sufficient to cover the mortgage, maintenance, management fees and taxes. Set aside a buffer for unexpected expenses or void periods and make sure that you're always operating with a clear financial picture. This will help you stay on top of your property finances and maximise the profitability of your portfolio. While buy-to-let properties can be incredibly profitable, they come with their own set of risks and challenges. By being mindful of these 5 profit margin killers, poor property selection, underestimating refurbishment costs, over-leveraging, not accounting for ongoing costs, and failing to track cash flow, you can avoid making costly mistakes that could eat into your profits. With careful planning, diligent research, and a strategic approach to managing your finances, you can make the most of the opportunities the property market offers while minimizing the risks. By taking the time to understand these common pitfalls and learning how to avoid them, you'll be better positioned to make better, more informed investment choices. As always, guys, thank you very much for watching. I appreciate you for being a subscriber, and I'll see you again on the next one.